Week 1, Lecture 3. The Efficient Market Hypothesis. The efficient market hypothesis was developed in the early 1960s by Eugene Fama. The efficient market hypothesis states that stock markets respond immediately to all available information. And individual investors cannot, therefore, in the long run, expect greater than average returns from a diversified portfolio of shares. In efficient markets, there is no bargain today, there is no memory of yesterday, and there is no knowledge of tomorrow. There are three forms of market efficiency. Weak form efficiency, which is seen in a market in which security prices instantaneously reflect all information on past price and volume changes in the market. Semi-strong form efficiency, which is seen in a market in which security prices reflect all publicly available information. Strong form efficiency, which is seen in a market in which security prices reflect instantaneously all information available to investors, whether publicly available or not. In terms of financial markets, the term efficiency generally refers to pricing efficiency. A perfect market, which implies market efficiency, has the following characteristics. Information is freely available to everyone in the market. There is a large number of buyers and sellers who may freely enter and leave the market. There is no taxation. There are no transaction costs. There is perfect competition, and no single buyer or seller dominates the market. Everyone in the market will be aware of any creative accounting and window dressing of the financial information contained in companies' reports and accounts. Financial assets are infinitely divisible. Bankruptcies may occur but are without any costs. Substantial research has been carried out with regard to each form of efficiency to test how efficient security markets, equity markets, and currency markets really are. For example, in general, these tests are categorized as weak form efficiency tests, semi-strong form efficiency tests, strong form efficiency tests. Weak form efficiency tests are designed to test the theoretical concepts that prices follow patterns that can be used to predict future prices. This means that all prices fully reflect information contained in past price movements. Such studies have found no reliable pattern that can be used to predict future prices, but have indicated that prices follow a random walk, which means that prices have no memory. Yesterday's prices cannot predict tomorrow's prices, and therefore only new information causes price changes. The random walk theory. The random walk theory suggests that share prices are independent of each other, and today's share price cannot be used to predict tomorrow's share price. Therefore, the movement of a share price follows no predictable pattern, but moves in a random fashion. This notion of random walk in the pricing of shares originates from the work of Kendall, entitled The Analysis of Economic Time series, and published in the Journal of the Royal Statistical Societies in 1953. Kendall examined the security and commodity price movements over a period of time. He was looking for regular price cycles but was unable to identify any. Essentially, Kendall's theoretical concept states that the random walk occurs because at any point in time a share price will reflect all information available about the share and the company and will only change as new information becomes available. However, because the next piece of information to arrive will be independent of the last piece of information to arrive, share prices react and move in an unpredictable fashion. Although the UK stock market and other capital markets apparently respond relatively efficiently to new information as soon as it becomes available, the assumptions of efficient markets may be open to debate. The efficient market hypothesis is a theoretical, analytical framework. In a perfectly efficient market, investors would receive their required returns dependent on the level of risk they are prepared to take, and no additional shareholder value would be created. In the real world, markets are not perfectly efficient. Additional shareholder value may be created by companies using appropriate financial strategies to exploit the different perceptions of the market, which are known as market imperfections. These imperfections include, for example, the information asymmetry that exists with regard to each of the shareholders in companies. For example, managers, directors, lenders, and shareholders each have different levels and aspects of information about companies and their assets. There may also be significant periods of time between when important information is revealed or acquired by each of the different shareholders.